Hello everyone, welcome back to the channel. In today's video, I'm going to speak to you about the top 3 mistakes that dividend investors make. And this video is mostly geared to new investors. I feel that maybe if you've had a lot of time in the investing community, you may be aware of these mistakes already, or you may have already made them in your earlier investment career. So you probably already know these, but I think for the new investors, these are very important mistakes to be aware of. And I picked a post out of the community on Reddit, Are Dividends, and this post here kind of exemplifies the first mistake dividend investors make, and that is ignoring diversification. It can also be over diversification, but I'll get to that in the end. What we see is with this user's portfolio, the holdings are heavily weighted toward a few individual companies. They do have some ETFs here, but those are relatively insignificant. So most of the portfolio seems pretty top heavy into just a few high yielding companies. So the first mistake is ignoring diversification. Neglecting diversification is a common mistake among dividend investors. Relying heavily on a few dividend-paying stocks or investing solely in a specific sector or industry can expose the portfolio to significant risk. If a single company or industry faces challenges such as regulatory changes or economic downturns, the investor's entire dividend income and capital value may be negatively affected. To mitigate risk, it's crucial to diversify across different sectors, industries, and geographic regions. By spreading investments across a range of dividend-paying stocks, investors can reduce the impact of poor performance in any one stock or sector. Diversification provides the opportunity to benefit from the growth and stability of various companies and industries, potentially enhancing the overall returns of the portfolio. So with the user's portfolio, you could see that it is heavily concentrated into Arbor Realty. So if anything happens with that company or anything negatively impacts the industry it operates in, this person's portfolio is going to be very impacted because it is top heavy with that holding. Their other holdings won't really help them too much because they're just not a big enough part of the pie to basically resist any impact that Arbor Realty may have going down. So looking at AT&T, which is a very common stock for dividend investors because of its high yield, had an investor focused primarily on investing in AT&T, they would have seen a decrease of about 34% of their capital in the past 5 years. So if you were obviously overweight in AT&T, your portfolio would be negatively impacted. I also want to speak about something else when it comes to diversification. I think for portfolio management, a lot of investors are also over diversified, or they have too many overlapping holdings. Their portfolio has no direction whatsoever. It's not really intended for a specific thing. If you look at it, you're kind of questioning why these people did what they did. So here's another post on the community speaking about their portfolio. This person says their portfolio is in shambles. So if we look at their portfolio, you can kind of see that it is somewhat over diversified here. There's a lot of individual companies and there are some ETFs that are the heaviest weightings, but we do see a lot of overlap when it comes to this. So I'm guessing that this person, being an Our Dividends community user, their intention is to produce dividends. So JEPI and SCHD aren't bad for the intended purpose of that, as long as you understand that JEPI operates as like a covered call fund. And they also have, it looks like, another covered call fund with QQQX. I'm not familiar with that, but it seems to be another covered call fund. So it looks like they have double diversification here. One's probably a covered call fund on the NASDAQ, and then JEPI is a fund that kind of does covered calls on a portion of companies out of the S&P 500. So I feel like this person could get rid of this right off the top, because there's going to be a lot of overlap between the companies that this probably writes calls on and then this company writes calls on, and you're also limiting your upside by investing in these covered call ETFs, because as companies go up, the call premiums are not going to make up for the income of lost gains with the shares being called away from the fund. I feel like this ETF could be gone as well, because their focus is on dividends, it seems, and it's a relatively insignificant portion. It looks like it's against their goal, and it just makes no sense to have, because it is a ETF that focuses probably purely on growth, being science and technology. They have Devo at an insignificant portion too, so you could just get rid of that. The S&P 500, there's no point. You have 2% of that, and it's pretty much covered by JEPI and SCHD, so I don't know why they have that either. A lot of these individual companies are probably a little too much for the new person to manage to investing. I feel like maybe if they want to do individuals, they could stick to like maybe 4 companies and pick the best of the best. So I think that some of these companies are redundant here. Like Realty Income, it's a monthly dividend paying company. It focuses on real estate. I feel like they could just put that into JEPI if they want the monthly payment. I don't know how much diversification having this REIT is going to really offer. But overall, it's just too much of a diversified portfolio with too much direction. There's a lot of overlap, a lot of needless things. They're on our dividends, but their portfolio includes AMD. If you want tech, just maybe put some money in QQQ, the regular fund, not a covered call fund. So we're going to get into most common mistake number 2, and that is ignoring the sustainability of the company's dividend. A lot of dividend investors, especially new ones, will purchase a company without realizing that the dividend comes from somewhere and that company needs to pay that out. And if they are not getting enough revenue in compared to their payout ratio, it's not really sustainable dividend, and it might lead to a cut. So we have Altria, which is a tobacco company, and the payout ratio on this company isn't like too bad. It is still rather high at 76%. So I don't think that this company is at risk of cutting their dividend anytime soon. Of course, they have 53 years of consecutive growth and a 6.7% 5-year growth rate over the past 5 years. But as these payout ratios get higher and higher, the dividend becomes more at risk. So popular stock when it comes to dividend investors was Intel, or is Intel. And this is a semiconductor company, and if we take a look at its payout ratio, we see it is just sky high. It doesn't really seem sustainable, and that is likely why the company did dividend cuts, and we had a lot of investors go in and purchase Intel, and Intel just eventually cut their dividend, which led to less dividends for the investor. And I thought they felt that it was safe, especially because the CEO and the company were making a commitment to sustaining the dividend, but at the end of the day, it got cut. They couldn't manage their debt. They had too much debt, and they were paying their investors billions of dollars per year for their dividends, and they were like, well, this isn't sustainable. We're going to need to cut the dividend. Otherwise, we're just going to get into more and more debt, and obviously that's not realistic for a company to have over the long term. So the dividend got cut, and investors lost out on the yield that they were anticipating. So going back to that portfolio I showed you a few moments ago, we're going to get into the final mistake that dividend investors make, especially new investors, and that is chasing yield. So this person's portfolio has a 6.7% dividend yield, which is quite high, and that is going to limit upward growth because that dividend has to come from somewhere, and it is going to limit your capital appreciation. So with these ETFs, the JEPI is a high paying dividend ETF, and I'm going to assume, based on its covered call strategy, probably that QQQX is a high paying dividend ETF. What we see with high yielding dividend ETFs and dividend stocks is that they have limited growth over time. So if we go to AT&T, we see that over the past 5 years, the company went down quite a bit. So no capital appreciation, only capital depreciation pretty much. And I assume that most people think they're making up for it by getting that yield, but truly over time they're just going to be losing out, even if they're reinvesting it, if the stock just goes downward. And you might be holding this in a taxable account, so your tax is going to be higher, so you're going to owe money on the taxes for this yield, and you're going to have an investment that is going downward. And we see pretty much the similar thing with other high dividend paying companies. Intel cut its yield, but for a while it was paying quite a high dividend, and we see this chart is somewhat similar to AT&T in that it just goes down. Final company here is Walgreens Boots Alliance, or Walgreens, and its yield is also high, and over the past 5 years it dropped almost 50%. So high yield or not, I think most investors would be pretty upset that the underlying asset that's supposed to be giving them this great cash flow just keeps going down and down and down and down. And there is an ETF that I hold that kind of exemplifies this problem. It's the only high yielding thing that I'll have because it is diversified across 50 high yielding companies, but this company basically specializes in picking high dividend companies, and we see its capital growth over time over the past 5 years basically being nil. There's limited capital growth over the past 5 years. It went up 3%. And now that is okay if you are just intending to get the dividend payments from the yield. But I think that most investors, especially if you're young, you should also include capital appreciation as a metric with your investments. This is why when it comes to my portfolio, I have most of my holdings into growth funds rather than SPHD. The monthly dividend is very nice, and it also limits volatility, but I'm also limiting my capital growth by holding it. So new investors, especially the young ones, should be investing more so into these growth ETFs with good capital appreciation rather than these high dividend ETFs that are going to limit your upside. So if we look at VIG over the past 5 years compared to SPHD, look at that growth, and I think if you're a young investor, this is probably going to be a lot more beneficial, growing your capital over time rather than having it into a high yield ETF or stock that is just going to limit your capital appreciation. And so basically comparing my two holdings, that is SPHD, the high dividend low volatility ETF, and the Schwab dividend equity ETF, we see that the performance of Schwab over time far exceeds the performance of the low volatility high dividend ETF significantly. So had you been a holder of this ETF over the past 10 years, I believe this is, you would have significantly underperformed a dividend ETF that focuses more so on dividend growth rather than just high yield. And what you'll find out is that it is generally better to hold lower yielding ETFs or lower yielding stocks when you're just starting out. So we have Kroger. This offers a 2.25% yield, but look at its 5-year growth rate in dividends. It is great. It's also got a low payout ratio. And over the past 5 years, we can look at how it did. And what we will find out is that it performs significantly better than the other companies like AT&T, Intel, and all the other high dividend yielding holdings, while also paying out an okay dividend and increasing your capital. So we see the same thing with Broadcom. We see a relatively minor dividend yield, a great growth rate, and let's look at its performance over time. And we see over the past 5 years, it did wonderful. Now, this operates in the same kind of sector that Intel does. They may have a little variance in how they perform their business, but would you have rather have owned Broadcom or Intel over the past 5 years? I think that most people, when looking at these charts and just their payout ratios, their yields, and their dividend growth, I think most people would definitely say they would have rather have owned Broadcom over Intel. And that is going to be it for today's video. It is kind of straightforward. It probably was more geared to the more novice investor or the investors that just needed a little guidance in adjusting their portfolio. Pretty straightforward, pretty simple. I think that most people, once they learn these things, they will get away from the overly complicated, over-diversified, overlapping portfolios and the high yield, no capital appreciation that they get. And their portfolios will perform a lot better over time than those high yield portfolios that generally just decrease in value. So thank you for watching today. If you enjoyed the video, please give it a like. It will be greatly appreciated. And thank you for watching, and I will catch you next time.